Today, we're going to break down a topic that confuses even really experienced real estate investors, including your CPAs. And the question is, how do you depreciate a mixed-use property? And when I say mixed use, I'm talking about two different really specific scenarios. First is a building that has both commercial and residential use. So this would be like retail on the ground level, and then apartments on the upper levels. So multifamily, as well as retail, all in the same building. A multi-unit property where some units are long-term rentals and others operate as short-term rentals. That's the second scenario. Both creating different tax rules and even different depreciation lives of how those are treated for tax purposes. These situations are becoming even more common, and the IRS has some really specific rules on how each portion of the property needs to be depreciated. If you get this wrong, you're at risk of overstating or even understating depreciation, which nobody wants. And the IRS looks really closely at these allocations. And so today I'm going to explain the rules in plain English as much as possible, cite the IRS sources behind them, and then show you how our team at Engineered Tax Services approaches these studies when we're doing cost segregation so that you can get the maximum benefit safely and correctly. So with that, let's jump in. So first off, the IRS has two depreciation life cycles. Before we get into mixed use, let's level set where these start. The IRS uses two main depreciation lives for buildings. 27.5-year residential rental property. That is defined under IRC Code Section 168. And then there's 39-year non-residential commercial property. So 27.5-year typically for residential, 39 for commercial. Now, one caveat, short-term rentals actually fall under the 39-year category because they're actually treated as a business like a hotel. So it's treated more like a commercial property, which is very unique. Many of the CPAs get this confused as well when we handle cost segregation. Every mixed-use situation comes back to determining which part of your property belongs in each of these categories. The 80% rule is ultimately how the IRS classifies a building. The IRS will use something called the 80% gross rental income test to determine whether a building overall is residential or commercial. The test comes from Treasury Reg subsection 1.168, and it also references an IRS publication 527. So here's what that says. A building is classified as residential rental property only if 80% or more of its gross rental income comes from dwelling units. If you are below the 80%, the entire building is then considered commercial for depreciation purposes, and then it's depreciated over 39 years. So that means it does not matter how much of the square footage is commercial versus residential. It doesn't matter how many units that are there. It is entirely dependent on income. So if you have, as an example, a $700,000 of rental income from apartments annually and $250,000 a year of rental income from retail, then the residential income percentage is 74%. That is below the 80% threshold. Therefore, the IRS would require you to depreciate the entire building over 39 years. Now, if the users are separate or the uses are separate, you can allocate the building basis. So this is another option. Even though the 80% rule determines the overall classification of a building, the IRS also allows for owners to allocate part of the building's basis to each separate use if the uses are distinct and separately rented or operated. So this is supported also by Treasury Reg 1.168, the IRS Cost Segregation Audit Technique Guidelines, what we call ATGs. They outline these rules as well. What they say is you must allocate the basis using any reasonable method as long as it reflects economic reality. The most common reasonable methods are first, an income allocation, which is the most common. This is preferred where commercial rent significantly exceeds the residential rent or vice versa. Number two, there's a square foot allocation. And this is used when the relative space usage aligns with the value. And then number three, there can be an engineering-based allocation. This is used in the cost segregation study, especially in really complex buildings. So let me give you an example. If we have a 60,000 square foot property, 40,000 square feet are apartments, 20,000 square feet are retail units, you can allocate 66.7% of the basis to 27.5-year residential, and then 33.3% to 39-year or commercial. Even if the 80% test makes the entire building commercial for classification purposes, you still might be able to allocate this basis for cost segregation based on the percentage. So this is where engineering team steps in, because these allocations really have to be reasonable. They have to be documented. and defensible. So that's really where the engineering studies come into play. Then the next portion is the short-term rental twist. So depreciation gets even more complicated when we're looking at short-term rentals, which are actually not considered dwelling units, if the average stay is 7 days or less. When the average stay is under 7 days, the IRS treats the property like a commercial lodging facility. So it's actually treated like a hotel. That means a short-term rental is treated as 39-year property. Long-term rentals, residential, are considered 27.5-year depreciation. These are both supported by different sections, but they're both in Section 168 of the tax code. These are also defined by passive activity regulations, which are under the tax code in subsection 469. It's a different code section that explains short-term rentals and how those are treated. Again, let me give you an example. If we have a 4-unit building, you have 3 units that are rented long-term, so 27.5-year property, but you have 1 unit you rent as an Airbnb that has average stays of 7 days or less, it is actually depreciated over 39 years. So you must allocate the basis between the different uses. And no, you cannot group the activities under 469 to get a single depreciation life. Grouping affects material participation only. It does not change the depreciation lives, which is dictated under Section 168. The IRS accepts multiple allocation methods if they are reasonable. When allocating the basis between short-term rental units and long-term rental units or commercial portions, the IRS allows 1, income allocations, 2, square foot allocations, 3, unit count allocations, which is rare unless the units are like identical, or 4, an engineering-based allocation. Because these allocations influence depreciation, the IRS expects them to reflect economic reality and to be well documented. That is exactly why mixed-use properties benefit tremendously from engineering-led cost segregation rather than just rule of thumb estimates or calculators or what we would call a limited scope allocation. So why does this matter for tax planning? Number one, accurate mixed-use depreciation can increase your current year deductions. They certainly can increase or improve your cash flow. They reduce your taxable rental income, enhance your long-term tax strategy, and provide better audit support, which is always important. Investors who do not incorrectly will often misclassify the entire building. They'll depreciate everything over the wrong useful life, overstate depreciation, which then that creates an audit risk, or understate depreciation, and you lose money. So when we perform studies at Engineered Tax Services, we carefully look at the building's actual use. We evaluate the supporting documents, we apply IRS-approved allocation methodologies, and make sure that we have accuracy so we're maximizing the deductions. Mixed-use properties can unlock a lot of really powerful tax benefits, but only if the depreciation is done correctly. Whether you're dealing with commercial or residential units or a mix of short-term and long-term rentals, the IRS expects you to classify and allocate the basis based on actual economic use, not assumptions. So if you want help to understand how much accelerated depreciation that your mixed-use property can qualify for, if you want our engineering team to analyze and correct any allocations, please reach out to us at Engineered Tax Services. We offer complimentary cost-benefit analysis so you can see upfront exactly how much tax savings might be available to you. And thanks for watching. We'll see you in the next video.